Something strange is happening in the Denver real estate market. One of the biggest local news outlets called it a broken pattern. Inventory is rising fast, but buyer demand isn't following like it usually does. In this video, we're unpacking what's really going on with Denver's unusual market behavior, how rising interest rates and seller incentives are playing into the shift, and what this all means if you're planning to buy or sell a home in 2025. I'm Landon, a local realtor here in Denver for the last 18 years, and I make videos all about life here in Denver. Let's start with the weirdest part. Denver's seasonal pattern has completely gone off script lately. So Denver's normal seasonality follows a pattern, right? Most years in my real estate career, I've seen home values tend to start out of the gates rising in January, and they continue to rise through about May, right? And then they kind of tend to ease off of that steep appreciation pattern, and there's still a little bit of growth in June. And then they start to flatten out, and we see a summer lull that happens between July and 4th of July and Labor Day. And it usually runs about a couple weeks after Labor Day. And so mid-September, we see a pretty strong market. And that summer lull from July to Labor Day usually dips about 3% in our market on average. And then we see things just flatten out through the holidays. But the holidays actually become like the second best time to sell a home between mid-September to right around mid-November. So that get in before the holidays crowd is actually a pretty good, like the second best market of the year to be in typically, because you got people that want to get in before the holidays or they want to get in before the end of the year for tax purposes. That's the normal pattern that we see year after year. And really that February to April, that 3-month window usually creates 75% of our annual appreciation that we see in our market every year happens in those 3 months. This year, it was completely different. So we saw just lagging like flat values throughout the course of the beginning of the year. We saw an abnormal spring that just does not happen in our market. So the only other time we had that was 2020. We had a very strange beginning of that year, which is self-explanatory. And then it was kind of like a boomerang effect that came back. And then the second half of the year, we had an unbelievable growth span that happened during that time. But this year it's been really flat. And so that pattern is not usual in our market, and it's definitely something that is causing some heads to turn. The other really big pattern is inventory is rising. So you're seeing homes increasing as far as the number of homes that are for sale in our market, going from 6,000 last year to over 13,500 right now. And so these seasonal patterns for active listings have increased dramatically, over 100% over the last year. And buying demand typically rises with inventory in normal markets, but the current buying demand remains flat and is actually down 15 to 20% compared to previous years. And that shows itself in showing counts, in number of contracts written, also in deal volume and number of deals closed. Definitely some things that cause you to scratch your head and wonder what is going on here in our market. This broken pattern suggests something fundamental has shifted in our market dynamics. So what's causing this unusual market behavior? The answer lies in something that affects nearly every buyer's decision-making process. And what I'm talking about is the interest rates and where they're at right now. Everybody's kind of on pins and needles to see if the feds are going to lower the federal interest rate here at the end of the month and give a little more help as far as that goes, because interest rates being high continues to make buyers feel pinched on a monthly basis. You know, you can say what you want, whether it's prices or whether it's interest rates, but everybody lives in the payment. So when you have price on top of interest rate, that's when, you know, people start to have some challenges, you know, and I think I told you in previous videos that, you know, over 70% of our buying population right now can't afford the average payment in our market. And that's a pretty high payment, you know, around $5,000 a month for our average home in Denver. And so obviously there's more affordable options in our market. And I would suggest looking at those if you're a buyer that's, you know, looking to be just into a home. There's the starter home market is actually one of the best markets to be in always, you know, regardless of whether we're in a recession or in a surging market, because they always are the first to lead out of a recession and they're the last to go into a recession because there's so much demand around those entry-level homes. Just something to consider. But with interest rates right now, they're at about 6.75% currently at the time of this video. And, you know, the average rate over the last 50 years is 7.6%. But again, we're talking about, times in the 80s when homes were $80,000 compared to now, when our average price in Denver, hovers between 780 and 805 right now. And so it's pretty incredible to see that the impact that these interest rates are making. That's why that buyer demand isn't kicking back like it normally would as far as our normal seasonal patterns go. The other thing affecting this is just the psychology of buyers, right? When you had rates as low as 2.25% all the way up to like 4% for 10 years in a market, everybody got used to what payments looked like with those kind of rates and, what borrowing looked like then. And so with this shift, the fastest increase in interest rates in history, it went up 3% in 3 months in the spring of 2022. This is when we're seeing a big difference compared to the demand that we were seeing during the pandemic, which was just off the charts, with how affordable and cheap it was to borrow money back then. So on an average house in our market, for each 1% that rates go up, it typically ups payments around $400 per month. And so if you think about, when rates were at 2.75% compared to 6.75%, that's a $1,600 difference on average in a mortgage payment each month. And so you can understand why, things are slowing down a little bit on the buying side. And that's what's producing these changes in our markets, normal seasonal patterns. This has dramatically decreased buyers' purchase power, meaning how much they qualify for a home, the price that they qualify for. Just recently, we've actually gained back. We went from about 7.25 to 6.75 recently over the last 3 weeks. And so just with that, we gained back about $20,000 in purchase power for buyers. So things are looking a little better than they were just a few weeks ago. But it's elevated to a rate that, some people can still handle with incomes, but there are a lot of people that are just uncomfortable buying when they're paying that much interest to the bank. So I have many potential buyers and people that have reached out, and a lot of you that have made comments on these videos that are saying they're just waiting, right, for rates to drop before entering into the market, or they're waiting for prices to drop. They're waiting for one or the other to happen at the moment. And so only time will tell, what will happen. I'm tired of predicting the market, honestly, because we've seen promises from economists for years saying rates are going to come down, rates are going to come down. And then they just keep on teasing us. They keep coming down a quarter and then up a quarter, down an eighth and then up 2/8. It's just one of those things where economists are right half the time is what I've gathered. And, they're not always right. I used to have so much more confidence in what economists would say all the time. Now it's like, you know what? I believe half of what they're saying or half of them. And, but you have to understand that no one really has full control of what is happening in the market. And so you have to base your decisions based on your own personal finances and what is best for you and what's comfortable for you. One thing we know, though, that affordability challenges are more pronounced than they have been in previous years. And buyers who have purchased at those 3% interest rates are reluctant to sell and take on higher mortgage rates. We have seen some people turn their home into a rental and then go buy at the higher interest rate where they're not losing out, because some of it's just FOMO. Some people can be approved for that higher interest rate on a new house and they can't afford it. Keep in mind, like maybe it's a select few, right? But they don't want to miss out on the equity and the cash flow that they have on their current residence. And so I've encouraged a lot of people to continue to rent their place while they go and buy another place, so that they can have that asset at a very low interest rate, because that's exactly what it is. If you have a low interest rate mortgage still at this point, it's a huge asset. So if you can hold on to it, it makes all the sense in the world to do that. This rate lock effect further constrains supply, particularly for move-up buyers who might otherwise be selling their starter homes. With buyers struggling with affordability, sellers and builders have gotten creative with a strategy that's becoming increasingly common in Denver. So let's talk about some of these incentives that homeowners and builders are offering right now that buyers are taking full advantage of in order to make this home buying process more affordable for them. The first one is called a 2-1 buy down, okay? And what this means is if a buyer is looking to buy a home and interest rates are at, let's just say 7% for an easy number, right? They can ask the seller to pay a credit to their lender which would allow them to decrease the rate temporarily 2% lower than where rates are at. So instead of being a 7% rate, it would be a 5% rate for the first year, and then a 6% rate for year 2. And then it would be a 7% rate from year 3 all the way through year 30. With this pattern, it would allow the buyer to save a really good portion on interest over those first 2 years. And the cost of doing this buy down, this temporary buy down, has to come from the seller. That's the interesting thing, is it cannot be done later on a refinance. The buyer can't give a credit to the lender to do this. It has to be paid by the seller for this to work out. In order for this to happen, the seller would have to pay roughly 2.2% of what the buyer is borrowing on the loan. So let's just say that the purchase price is right around $800,000 on the home, but the buyer's only borrowing $600,000. They're putting $200,000 down for a down payment. Then the cost of this 2-1 buy down would be right around $14,000 in this case, that the seller would credit to the buyer, and they would get $14,000 less for the sale of the home. The buyer would walk into an interest rate that's 2% lower than today, where if you take the real example from rates today that are like right around 6.7%, now we're talking a 4.7% interest rate for year 1, 5.7 for year 2, and then 6.7 thereafter. So that's how those work. There's also other variations of this. So there's a 1-1 buy down. That's just a 1% temporary buy down for 1 year. There's also a 3-2-1 buy down. So 3% off the rate for the first year, 2% the second year, and 1% for the third year. So you can get creative on these. And the cost for the 3-2-1 buy down for the average price here in Denver tends to be right around like $25,000 to $30,000. So that one's expensive. But the cost for the 1-1 buy down is actually only, $4,000 to $5,000 typically. And so there's a way to lower your interest rate initially, especially if you're one of those people that believes that rates are going to continue to drop down and be better and more affordable in a year or two. And so very likely could happen. I just don't know, and I'm tired of predicting it, to be honest. So buy downs, are a great thing to look at if you're a buyer in this market. And it's something that sellers are willing to do, especially after they've been on the market for a while. Obviously, every home situation, every seller's situation is different. Some homeowners are just holding out because they have to get that bottom line. But others, it doesn't make sense to do that because it's costing them too much to keep this vacant home with the payments that it has on the market. They would rather just pay a buy down option or pay for buyers' closing costs, overall, to make sure that they can get the home sold. Buyers can also do permanent rate buy downs. And the permanent rate buy downs, buyers can actually credit the lender to get a rate that's lower than what the market rate is. However, these buy downs cost a lot more money, and it's scaled. So the first quarter is a lot less expensive than the next quarter percent, and the next quarter percent just gets, incrementally, so much more expensive to where it doesn't even make sense after like a half point in most lending situations. And so just be aware that temporary buy downs are very different with how they work. And you can use seller paid concessions or closing costs. Concession is just another word for a seller paid closing cost for buyers to go towards temporary and permanent buy downs. One thing to note though, these temporary buy down options are not available on all types of loans. They're not available on jumbo loans. So anything that's above the $805,000 conventional loan limit that will be allowed by conventional loans and FHA and VA typically. If it's above that threshold, a jumbo loan can't do a temporary buy down. And I haven't met a product that works for that. So another thing to note is builders are also offering these incentives in a big way. And one thing that builders do that a lot of homeowners can't do is they're bulk buying down the rates. So they'll negotiate with a huge number with a lender to say, hey, if you'll lend us $100 million at this rate, we'll buy the whole thing, right? And then they can lend at 4.99%, for a fixed rate for 30 years in some cases, instead of, what sellers can do, which is just a temporary buy down. So if you want to lock in a fixed rate in the 4s, builders are offering that right now. And there's several of them in our market that are doing that. And so that's something to consider. I've even seen, we actually had a buyer close a couple months ago where they had a 4.99% interest rate, and they also had a 2-1 buy down on top of that. So they're starting at 2.99 and then for year 1, and then it's 3.99 for year 2, and then 4.99. It's locked in for the next 28 years. Be aware that builders and buying a brand new home, sometimes it does make sense if you can lock in that lower rate for the long term. Speaking of forecasts, one of the most respected voices in real estate has some predictions about where this market is headed. So Lawrence Yun is the chief economist for the National Association of Realtors. He's someone that I've listened to a lot, very wise in some of the things he's said. A lot of his predictions have come true. And keep in mind, a lot of these economists, they've been like verbatim, like predicting the market for years. And then the last 3 years has thrown a wrench in everything. Because of the unpredictability of what's going on in the background. And so he's had, a lot of things that he's gotten right. And so I respect Lawrence Yun above a lot of the other economists out there. And he is forecasting a 9% increase in home sales nationally for 2025, meaning that 9% more sales will happen. More people will move, not the values will go up 9%. And he also predicts that in 2026, we'll see a 13% increase in people moving and more transactions happening during that time. And part of that is just pent up demand. You have people staying on the fence for years, for the last 3 years, and not moving has created a lot of needs for a lot of people that have real needs, whether it's a family size need, whether it's downsizing, lifestyle changes, jobs that move them to other places. And there's all kinds of reasons why people have to move. It's not just a greed thing, it's more of a need thing. Lawrence Yun expects mortgage rates to stabilize around 6%, 5.5 to 6.5 range. And he says that he anticipates multiple Federal Reserve rate cuts in 2025. So we've already seen one. We might have another one coming up. It hinted towards that for the end of the month in July here, so we'll see. Also, Lawrence Yun believes the worst of the housing inventory shortage is ending. And he projects that the median home prices will rise in the country by about 2% in both 2025 and 2026. When Lawrence Yun speaks about real estate trends, a lot of smart people do listen. Yun is essentially the Alan Greenspan of housing. His forecast carries serious weight. So what does this all mean if you're a buyer in today's unusual Denver market? Buyers have more options with this increased inventory. I can't tell you how many times during the pandemic I heard people say, we're just going to sit because we don't see what we're looking for. The options are terrible. We can't find what we're after. And that happened a lot back then. And so, the fact that we have all these options on the market is a blessing. It's an awesome thing. And it just creates for so much selectivity for buyers. It's a fun time to buy a home right now. Other than the payment, it's a really fun time to buy a home. Let me put that caveat in there. But sellers are willing to negotiate on price and terms. And the builder incentives are becoming more common and substantial compared to what we've seen in the past. And that less competition for buyers means fewer bidding wars. Contingent offers are more likely to be accepted if you need to sell your home, you've got it under contract, and then go buy a place. That's getting accepted more often. If you still need to put your home on the market and you need to sell your home to buy, that one, we're still not seeing a lot of sellers jump at that one, but they are scattered. There are scattered occasions where they will, depending on their motivation. Because if a seller's been on for 90 to 120 days, plus, and they're thinking, oh my gosh, all hope is lost. We cannot find a buyer for this home. And someone comes along and they offer something like that. It's the only thing they can latch on to. And so sometimes sellers will go with an option like that. And it's a bit of a prayer, right? That home is going to sell and go through with a successful closing before those buyers can buy that listing. But it does happen every now and then. Buyers can request inspection items to be addressed, and oftentimes they're getting those done. Sellers are agreeing to them to keep the deal together. Rate buy downs can significantly improve your short-term affordability. And, waiting for lower rates means potentially facing increased competition down the road. If rates drop, I could definitely see a lot more buyers entering the market. If you're a buyer right now in Denver, you're in a much stronger position than you have been in the past, even a year ago. With inventory up and competition down, you finally have breathing room to make thoughtful decisions. The big question is, should you buy now or wait for rates to drop? Here's my take. If you find a home that you love and you can afford the payment, consider buying now and requesting a rate buy down. You'll have more negotiating power today than you might have when rates drop and other buyers flood back into the market. Remember, you can always refinance when rates improve, but you can't go back in time to get that perfect home you passed on. But what if you're on the other side of the transaction? Let's talk about what sellers need to know in the shifting market. Days on market have definitely increased for sellers with the increase in inventory. And so proper pricing is more critical than ever. It is so important to price your home correctly. The average is seeing a home come on the market, go down 1% on a price reduction, go down another percent, and then sell for 2% less than that. That's what's happening most commonly right now. But if you get ahead of that and you price it 2% under, where you think, pricing might be, that's one of the best strategies you can do. Most homes are selling below asking price. Seller concessions, especially rate buy downs, are increasingly common. So home preparation and presentation matter more in a buyer's market. Sellers need to be prepared for inspection negotiations. Properties in prime locations still command premium prices. Sellers should expect more detailed negotiations than in recent years. Let me tell you, after just negotiating through a couple listings through inspection, it is not the funnest experience right now. So be prepared for a little bit of patience and grind as you get through some of those items, and hire a great listing agent that can get you through those and minimize the damage as you go through the inspection negotiations. If you absolutely need to sell in this market, focus on making your home stand out through proper preparation, professional photography, and strategic pricing slightly below comparable sales to generate interest. Looking at all these factors together, what's the bottom line for the Denver market right now? So I think that what we should be realizing is that we're going through a shift, right? And that Denver appears to be shifting towards a buyer's market. Currently, inventory over 13,000 homes is still far under the 28,000 homes that we had during the Great Recession. The key difference from the Great Recession to today's buyer's market is that buyers are facing higher interest rates versus the 3% rates that they saw back then. Denver's strong job market continues to support housing demand. For the most part, not for everybody, I understand that, but for the most part, it's still hanging in there. Population growth remains positive despite quite a bit of out-migration that we're seeing, and new construction continues to add to inventory. Denver's desirability as a location remains strong. Market balance is healthier than the extreme seller's market of recent years. Buyers have options. Sellers can still sell for good prices if they're realistic, and we're moving toward a more sustainable balance. If you're thinking about buying or selling in this unusual market, you need someone who understands these shifting dynamics and can help you navigate them successfully. I've helped dozens of clients make smart moves in challenging markets just like this one. Give me a call or text me at the number on your screen, and let's talk about your specific situation and how to position you for success, whether you're buying or selling. If this market breakdown was helpful, you'll definitely want to see my next video where I compare Highlands Ranch and Littleton, two of Denver's top communities, head to head. Find out which one is a better fit for you. Click right here and I'll see you there.